Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Edwards Lifesciences Corporation, ticker EW. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. First up is market cap. This company has a market cap of $46.9 billion, enterprise value of $45.8 billion, which means they have about $1 billion in net cash on the business spot, which looks really good. I like the net cash businesses more than the net debt businesses. Tends to show that they are free cash flow positive. Now, industry is healthcare equipment and supplies. Can be a pretty good industry depending upon the moat around the products. So Edwards Lifesciences Corporation provides products and technologies for structural heart disease, critical care, and surgical monitoring in the United States, Europe, Japan, and internationally. It offers the transcatheter heart valve replacement products for minimally invasive replacement of heart valves. It looks like it provides the Pascal, Cardioband, transcatheter valve systems, has surgical structural heart solutions, Inspirus name, Connect Resilia, Harpoon. Company provides critical care solutions, advanced hemodynamic monitoring systems. So what's interesting, so the company distributes its products through direct sales force and independent distributors. So what's interesting to me about this product is that it's this critical care, which means that they could probably have very strong pricing power. Certainly in the United States, where you don't really have a lot of limitations on what you can price things at, surgical monitoring, these sort of critical care solutions probably can offer very high-priced products, which could be very good for their business. And if these brands have a moat around them, which I don't know off the top of my head, could be, quite sustainable and in a really nice setup. So beta 1.14, pretty standard and normal. Now, the return on invested capital chart looks really, really interesting. First thing you can see immediately is they have 20 straight years of profits. There's not a single loss in the last 20 years. That's a very good sign of a high-quality company. They got close in 2004, but for all we know, this is a one-time item or something. Otherwise, they've had really good returns. The lowest returns besides this 2004 blip were in 2002, and they've been pretty much steadily growing since then. They have been double-digit return on invested capital since 2006 with 13%. They had a low in 2007 of 11%, and then it's just gotten better and better from there. 12, 19, 16, 16, 18, 20, 32% in 2014. It's probably some one-time items in here. 16, 17, 15, 18, 24, 16, and 25. What I really like about this is that all of the numbers since 2009 are higher than 15%. 15% plus is what I look for in a return on equity number. But if you can hit it on return on invested capital, then that means that you can get a 15% plus return without leverage, which means that it's even safer than a company that has to use debt to get up to that 15% return on equity. Really, really interesting numbers here. I like what I'm seeing. Anytime you're hovering around this 20% line, things start to get very, very interesting as a return on invested capital basis. So every indication of a high quality business here. The other thing to note is just this general stability. There's not cyclicality here. All good signs. Now, the return on equity is even higher than the return on invested capital. We see return on invested capital averaging 18.6%, which is just awesome. 20% plus returns on equity. There's almost no difference between 20 and 23%. Either way, they're very good returns and certainly sufficient for what I would be looking for in an investment. So, very high quality company, meeting all of my metrics so far on that standpoint. Now, the first concern that I have comes with valuation. Valuation here, we have a PE of 32. First thing I'm going to question is this PE real, or is it caused overstated by maybe some recent earnings being lower than in the past? When I do a quick look at the earnings per share here, it doesn't look like that's the case. The most recent earnings is the peak earnings, $2.38. That tends to match up well with this $75.96. So if anything, it could be overstating current earnings if these aren't sustainable at $2.38. But let's assume for now that they are. And on the whole, it looks like this company's probably certainly on the high end of its valuation, maybe overvalued. But when you think about it, you have some very good growth numbers here. So I like to see revenue growth and EPS growth in the double digits, and all these numbers in the double digits, which is really, really nice. 10% revenue growth is awesome. 12% is really good. When you can sustain that for a decade and you add operating leverage on top of it, you start to get these results like 20% free cash flow growth, 21% EPS growth. This is amazing growth over the course of a decade. If you could expect that going forward, which I don't know if you can or not, but if you did, then you would expect very good returns, even paying a high price like this at 32 PAE. Now, presumably this would slow down at some point because you can't compound at 21% forever. But the longer you can, the better it is. And what's happening here is you're turning this 12% revenue growth into 21% EPS growth because you're increasing your operating margins. Look at how this has grown from 22% at the beginning of the decade to 30% at the end of the decade. That's a really good number to have a 30% operating margin. And you might still have room to go. I mean, your gross margin here is 76%. So with only minimal increase in the gross margin, which has been basically pretty stable, you've been able to grow that operating margin. There still might be room for this operating margin to grow. Now, if it can't grow that much more, then you're going to tend close to this 12% revenue growth, which is certainly sufficient for a very high quality company. They're definitely reinvesting their money well. I don't see dividends here is the only thing that maybe I would want to see, but otherwise not a concern, and potentially the price is just a little high. Again, I'd love to buy this company at a PE of 15, but a company with these metrics just never trades that low. Something like a PE of 20 becomes a really good entry point when you get a high quality company with such amazing growth like this. Now, if you're enjoying this video so far, hit that like button. Don't forget to subscribe, ring the bell, get notified as I upload new videos each and every week. Let's go to the income statement now. You can see that they continue to throw money into SG&A. So that is where, some of this growth and expenses is coming from. They are throwing money into research and development. Research and development has basically 4x'd, maybe 3x'd over the last decade, which is pretty significant, but it's actually gone up slower than operating profit, which is certainly okay because you can see the operating profit's almost up 4x. Likewise, SG&A only doubled over the course of the decade. And so the fact that you're able to grow those a little bit slower than your gross profits, allowing some of this operating profit growth. Really like what you see there. When you think about these pre-tax income numbers, you're 3 to 4xing in a decade, which is really good. I mean, net income going from 300 million to 1.5 billion. That's a 5x in a decade. Anytime you're 5xing your earnings in a decade means that if you just maintain the same multiple, you're going to 5x your returns in the shares in that decade as well. And it also means that you can allow for some multiple compression and still get a really, really attractive return. Remember that if you double your shares in a decade, then that's about a 7% return. If you are able to quadruple your shares in a decade, you're talking to get really, really good returns there. 5x in a decade is very, very attractive. I mean, I think it's like 4x in a decade is something like a 15% return. And so you're starting to average that 15, 18, 20% returns that they have shown over the last decade. If you can repeat that again, very, very impressive set of results. Now, one thing that's also really nice is you've had your shares being bought back as well. You've gone from 710 million shares outstanding to 631 million shares outstanding, which means you've retired about 10% of the shares in the last decade. That's going to add about 1% per year to your return, which is a good use of capital to just kind of boost and boost that EPS. So you really like to see that, and it means that your actual EPS is going to grow faster than your net income. Let's look at our balance sheet. One thing that's worth noting, though, is they've certainly grown their PP&E quite significantly. They've 5x their PP&E from 300 million to 1.6 billion. But again, they've grown that faster than revenue, but not faster than earnings. And so that's an okay setup. And it's certainly something that's allowed them to drive their growth. And so we can see that this investment in capital has paid off in spades. You're doing really, really good returns on that capital. So I have no concerns with the growth in that. They do have some long-term debt. They've gone from 150 million to 500 to 600 million, but they have even more cash than they do debt. So they've maintained a net cash position this whole time. I really like to see that. That means that the company doesn't really have a lot of liquidity concerns. Very good setup there. You can see they're running a really lean balance sheet. I mean, You look at these numbers, only $2.6 billion in total liabilities, and yet the market cap is $46 billion. So total liabilities is less than 5% of market cap. This company is in a good spot. I mean, total liabilities are less than 2 times your net income, and I really like seeing that. So they have a really, really nice balance sheet. So strong income growth, nice balance sheet, everything's flowing together well here. So cash flow statement. One thing that's a negative is, of course, you have stock-based compensation. I would love for every company to have no stock-based compensation that I invest in, but sometimes when you get really, really good results, stock-based compensation is part of the formula. One thing that's nice is they are buying back stock every single year, and they're buying back more stock than they are issuing shares. That's allowing them to retire those shares over time. They're basically using all of their excess free cash flow on share buybacks, besides what they're investing in acquisitions or PP&E. You've had some increase in the balance sheet, but they're really dumping a lot of that money into share buybacks. I'm actually okay with that. I would prefer companies to focus exclusively on share buybacks instead of dividends. It's just a really nice setup for compounding your results when you have a really high quality company. There's no reason to pay dividends. You'd want to buy more of that company anyway. You want to own more over the long haul. So it's just a good setup for capital allocation. So let's summarize Edwards Lifesciences Corporation. You have a very high quality company. It's not cyclical. Strong returns that are hovering around 20% return on invested capital, which means you can get 20% returns on equity without leverage. These high gross profit margins of 74% are allowing you to grow your operating margin from 22% to 30% over the next decade. If you can continue to expand your operating margin, you're going to be able to grow your EPS faster than revenue, which makes for a really nice setup for future returns. The only downside is the current price at a PE of 32 is just very high. It means that a declining PE ratio is likely in the future, which is a headwind for future returns. If you could get it at a cheaper price, it could be very, very attractive because the growth is amazing, the returns on invested capital are amazing, the lack of cyclicality is amazing, gross profit margins are amazing. My only downside is price, which to me means this company is going on my watch list, Edwards Lifesciences Corporation. If you enjoyed this video, hit that like button. Don't forget to subscribe. At the end of the video here, we have a playlist for the 150 S&P 500 companies I've already covered. I think you'll enjoy checking that out. And if you like this software, quickfs.net, the link is in the description below. It's the first link in the description. And if you check it out, that's my affiliate link. If you sign up, that's a great way to support the channel because I can get a commission for a free or paid account by sending you to them. And I really love using this software. Look at how easy it was for me to analyze this company and get a new company on my watch list in only 10 minutes. Thank you for listening. And until next time, stop paying fees, start building wealth.